Most owners picture one kind of buyer, but there are really two. You have a strategic partner backed by private equity, which is who we work with most of the time in our deals. And then somewhat rare, the large private company that can also acquire. Knowing the differences can shape your whole transaction. Listen till the end. I'm going to talk you through this. So what basically makes them different on the surface? So a strategic acquirer who is backed by private equity really operates very similar to a large privately held company, but a large privately held company is typically from private money as opposed to having a private equity sponsor like the large strategic acquirer. So you have a strategic acquirer that's backed by private equity versus just a large private company, typically family money, borrowed money, etc. So what I want to do today is let's walk through some of the pluses and minuses of doing a transaction or becoming a partner with one of those two, strategic private equity backed or large private company. Let's start with a strategic partner that is backed by private equity and some of the pluses. First and foremost, they're going to have more availability to funds, cash, than a large private company because they are backed by a private equity group that has investors. So there's a lot more capital there. So typically in a transaction, there's going to be a lot more cash at closing in a deal with a large strategic backed by private equity. In addition, those companies typically will buy a platform and then they will grow from there. So the private equity group buys the platform and then they continue to grow from there. Many instances, they're growing resources. So for example, they may have billing and collections and a large system to do billing collections. They have IT departments. They have integration departments. They have acquisition departments. And you're going to like this one. They have recruiting departments. Many cases, they'll have training as well as learning opportunities, teaching and learning opportunities for your therapists, as well as your clinic directors, as well as your leaders. So they bring a lot to the table in terms of support after a transaction. And I think the other plus to being part of a strategic private equity backed company is that in many cases, when there are troubles in the economy, or there are troubles facing physical therapy, Medicare cuts, payer cuts, rate cuts, et cetera, they're typically more able to get through those periods. Why? Because they have more capital. They can get through these periods. Then finally, if you're looking for a rate lift from an acquirer, typically the strategic private equity backed companies are larger, so they have more leverage with payers, which they then can pass on to you when you become a part of that company. So those are really the pluses of being acquired by a strategic private equity backed company. What are some of the minuses? As I described it, backed by private equity many times will bring in their own leaders to lead the company, the first platform that they've acquired. This begins to build layers of management. So as these companies continue to evolve, you may be acquired, and you'll never even talk to the CEO or the chief operating officer. You're talking and communicating with leaders that they have hired that are then shown to be managing you and your business. And I think that's one of the big downsides that we've seen, depending upon those leaders. We've seen many instances, those leaders are very intelligent and great to work with. We've had situations where it's been just the opposite. I think another minus is, remember, a strategic backed company by private equity is going to be on a cycle of when they are going to transact, meaning the big company, okay? So typically the PE group on a 5-year cycle or so will go through what we call a recap. They're going to sell to another private equity group. Depending upon where you are in that recap cycle, that could mean a new set of advisors on the outside, financial advisors from that new private equity company. So sometimes that goes well, sometimes that does not go well. I think that timing cycle can also, if you have equity in the parent company, which can be a positive, but if in fact that cycle moves to a 6 or 7 or 8 year cycle and you have equity up in that parent company, that sometimes can hold you up from getting out what you thought you would get out. So those are some of the minuses of being a part of a strategic company that is backed by private equity. Let's now talk about large privately held companies and some of the pluses that you would have in being in a transaction and being part of a large privately held company. The word private typically means that it's somewhat smaller, but these can be 50, 7,500 clinic companies, but they are somewhat smaller. And in most cases, when you're acquired, you will have better access to those original leaders who acquired your business. And that may feel good to you that you're able to have that contact because those were the folks that at the closing table made you feel so good about this company, and you can continue to communicate with them on a very regular basis. I think another positive to a large private company is that depending upon where your equity piece would be structured, if that large private company then goes into and becomes backed by private equity, those events tend to be really large. And if you have equity that you have rolled, that could be a big event for you as a owner and as an equity shareholder in that company. I think some of the other pluses of being a part of a large private company goes back to the old, do you want to be a small fish in a big pond or do you want to be a big fish in a smaller pond? In this instance, you are a bigger fish in a smaller pond in most cases, which enables you to have a position that may be more recognizable as a part of the large company. And that could be a plus for many of you who have been looking to, at some point, be a part of a larger company. All right, what are the minuses of being acquired by a large private company? If we go back to some of the pluses of companies that are backed by private equity, first and foremost, most typically, depending upon the size of your company, you're going to get less cash at closing. That is just the way in which these large private companies can borrow and the amount of capital they can put in cash to a closing. So that can sometimes be an issue as it relates to structure and risk. Another minus of being a part of a large private company is that many times with a large privately held company, you don't have the access to improved payer contracts. You don't have access to departments of folks that can support you and your growth. For example, an IT department, as I said, or a recruiting department, teaching and training and leadership training, human resources, acquisitions, startups. So in many cases, they don't have the level of resources in a large privately held company that you would have with a private equity backed company. Private equity backed company really builds those leadership levels as well as building out the resources available. The large private companies simply do not quite as the level of a company that's backed by private equity. So I think when you look at this, and finally, as a large privately held company, another minus to that is depending upon what resources are available within that company. Again, I said the payer rates, you may not have access to significantly improved payer rates like you would with a larger private equity backed company. So as it relates to simply a process and making a decision on whether you are acquired by a large privately held company or a strategic company backed by private equity, I think it comes down to three things, and I'm going to say this very clearly and slowly. First, as you look at the companies that are available to become a partner with, first and foremost, what company is the best culture match with your company? And the only way you can do that is to meet face to face with the owners and leaders of these companies, but culture is first and foremost. Next is structure. The structure of your transaction. Where is your equity going to be held? How much cash at closing? What are some of the legal ramifications with a note? Or is there an escrow that's being held? What happens to your equity when it rolls forward? So all these are very important as it relates to structure. And then finally, price. Okay. If you have a deal from a large privately held company that is at 8 times and a private equity backed company's offering you 5 times, that's going to be really hard to make up that difference in the 5 to the 8. Price does matter, but it's only after culture and structure. And it finally goes to the waterfall effect here, is that the only way to determine what are the companies out there that meet your culture, structure, and price needs, you have to run a process where you put all of those potential acquirers on the same starting line at the same time, and then drop that checker flag and run to the finish and pick the company that brings you culture, structure, then price. I thank you for joining me today. If you have anything you'd like to talk to me about today, or you want to visit me on YouTube or LinkedIn, just click below. Let's talk.